Yellow, happy Tuesday, guys. Wow, this is different for me, man. I have not seen a live stream on a Tuesday. Well, this is the new schedule. I hope you guys are having a good day. Welcome into the Everyday Growth Advisors webinar series. This will be held every Tuesday and Thursday from now on, where we teach interesting topics that are off market fundamentals. Okay. And today we will be going through a quick lesson on some market fundamentals. I'm going to kind of give you guys what I know, what I feel, what I see about the market. This is a off-the-cuff lesson that will be mostly visual, hands-on, and I'm going to go through the basics of a couple of ideas and things that I like to explain. Okay, so welcome into the stream. Good morning. Hope you guys are doing great. Happy Tuesday. Crazy week with the stock market continues here, as we see all in the indices trying to break through these key levels. Nice little correction on NASDAQ happening, which we should expect to get a little more exaggerated sometime today. Just giving you guys a couple of updates here. And the Dow is ready for a nice bounce over here. So just wanted to kind of go through a little bit about market fundamentals. What you should be looking at, what you should be knowing about market fundamentals. Most of you know about the fundamentals of the market by just understanding, the basics of how candlesticks work and stuff like that. And I want to dive into that today and actually go through with you how these candlesticks actually form, right? What is the basis of this, right? How do these candlesticks actually form in the end? That's the question, right? And also, once you understand that, it's also diving deeper into supply and demand and how stocks exchange hands of different traders before it actually gets to the chart. Okay. So those are all going to be discussed today in this short webinar, which is going to be roughly 30 minutes. Okay. We're going to actually try and make it about 20 minutes. I want to make it a short and sweet lesson so that the people who are listening in can kind of get a good idea. Okay. So going into market fundamentals here, I just want to dive into head first. Okay. Now, we all know that there are multiple indices that make up the entire stock market. Okay. And we have the Dow Jones, the S&P 500, and the NASDAQ. Okay. These are the most commonly followed indices that we track on a daily basis. But they all represent different things, okay? And they all track different things. And if you want to know what they track, I have a neat little infographic to show you what they track. So let me actually pull that up real quick. Let's see here, Instagram. And it's going to be... Oh, not here. It's going to be on my Instagram. Okay, let's pull it up real quick. By the way, if you haven't given me a follow on Instagram yet, I would highly recommend to go follow me on Instagram. I post a lot of great content. My tag handle is Everyday Growth Advisor. There is all kinds of content that I post every single day. Stuff about gap fill, stuff about day trading, swing trading, scalp trading, how to master emotions, factors that shape the market, right? What about also, if you go far way down below, you will see a infographic that I posted very long ago about indices. And this is what I want to talk about today, right? The basics of indices. Not many people know this, okay? But this is what makes up your majority of the time. If you're looking at, for example, McDonald's and you want to trade McDonald's, right? Well, you have to look at which indices it's formed from, right? And you can see McDonald's forming a very nice cup and handle formation here, looking like it wants to make a continuation here with the nice cup and a handle, right? It could easily see, a nice a channel forming up here. We had some volume come up, and we'll see whether this happens today. Let's look at extended hours and see what happened here. Yep, not yet, but definitely looks bullish to me. McDonald's from here, right? You can see that nice cup and handle formation. So when we're looking at McDonald's, for example, we want to trade McDonald's. Well, how do you go about doing this? Where do you start, first of all, right? I know my chart looks all crazy and all that. We'll get to that on Thursday, which I'm going to teach you guys a little bit about charting. But what I want to really get at here is how do you, start to break down your trade ideas? How do you come up with them? Okay. Well, if you know McDonald's is part of the Dow Jones Industrial Average, and it's one of the Dow Jones is one of the most oldest famous indexes that track, 30 of the largest base U.S. companies. Okay, and this is a price weighted index. So stocks with high prices, those are what will cause the index to sway. All right. So if you know this, then you know that McDonald's will cause the Dow to sway. Okay, now where the Dow is another question. Now, do you think that the Dow is poised to make a run up here? I certainly think so, right? Why? Because we are now using these little moving averages as a support, right? And we're looking like we want to make kind of higher highs here, right? Which is a uptrend, right? And then we're also making these higher highs but higher lows. So we are officially in a uptrend, right? And this could easily continue. So now if Dow pushes up here, what is it going to take along with it? It's going to take McDonald's along with it, right? And you can see McDonald's with the cup and handle formation, it's poised to break out. So this is a trade idea right now. You see how you form the trade idea? It's okay. But then if Dow wasn't bullish and it was bearish instead, then there would be a downward pressure on McDonald's instead. So you have to think about it from that perspective and think about it from that angle, that okay, are the index and the stock itself matched up in terms of momentum, right? And then once you figure that part out, then you can start looking for other kinds of cues, okay? Then you start looking at other things, all right? So this is one thing, market mechanics 101. How do you figure it out? Okay, this is important stuff right here, what I'm teaching you, okay? So I hope you guys are having a good day so far. Good morning, guys. Welcome in, welcome in. Hope you guys having a good one. Make sure you smash the like button. Welcome into the stream. Hope you guys find this webinar useful. I'm going to try and keep it short and sweet and go as concisely as possible today, just to keep everything in order here. Okay. So next step here. So now okay, McDonald's is doing this, doing that, right? And then the Dow Jones is also poised to move up. McDonald's belongs to Dow Jones, also belongs to other indexes, right? Now you want to find out what other indexes belongs to which indexes. Find out which indexes McDonald's belongs to, right? And then you can say, okay, so it belongs to Russell 1000, Dow Jones, S&P Consumer Discretionary, Russell, S&P 100, S&P 500, belongs to all of them. So now you go look at the S&P 500. Is the S&P 500 in the uptrend? Absolutely it is, right? It is, but it is going to face some downward pressure first. You can see down the 4-hour chart. And you can see that the S&P 500 has been making these large dips, right? And so it has to make another dip here, right? So then it might bring down McDonald's with it. Okay, so now do you enter McDonald's here? Probably not, right? Okay, so what do? You wait. You have to wait, right? You have to see, okay, is McDonald's going to break above this level here, right? It has good volume as of yesterday, right? It has all the indicators. It has that big volume that came up, a corrective wave, consolidation, and now we're looking for this to break out over the 195 level, okay? So your entry point or your trigger to enter should be at 196. This is literally how you're creating your own watch list right now, right? Okay, so you have the signals, you have the idea, you have the trade formation, and now all you're doing is you're creating a upper bound. And then when does it go bearish? Well, it goes bearish if it goes below a certain level, right? And what would be that level that would confirm that it's indeed going back in a downtrend? If it starts to trade below these moving averages, right? So if it starts to trade below the moving averages, it has to trade below this 193, 193.50. So we can say 196 would be the upside break and 193 would be the downside break. So now you have your upper bound, 196 plus. This is going to be your upside breakout for McDonald's for your watch list entry. For your downside, this is going to be your downside risk. Now, obviously, you have to look at this on a 1-hour chart and see what's going on as well. This is important, right? So you can see that, okay? 196 would be above this level, right? Over here. And 193 would be below this level, right? So confirming this downtrend, if it breaks below and if it breaks above here, you're confirming a reversal pattern, okay? So this is how you literally come up with trade ideas. Now, obviously there's much more to this. You're also going to have to go one step further and figure out if there's risk to reward in this trade, okay? And so how do you do that? Well, that's a different thing, and that's a different lesson. That is a more complex subject that we will talk about in a different time, okay? So Market fundamentals are exactly like this. How do you come up with the trade idea? You look at the index, you look at the momentum of the index, you look at which index this stock is a part of, which member it is, okay? Look at the market momentum, look at which index is pushing up against that, and does the market favor that index, okay? Now, McDonald's is on a uptrend, right? It is on a uptrend, okay? So it is favorable for this to go bullish again, okay? It is favorable for it to go bullish, all right? And its earnings just passed. It didn't do extremely well, but there is a favorability for this stock to go back up, okay? So you have to wait to see now, okay? You can't enter this trade where it is. You have to wait to see if it breaks above 196 or below 193, 192-ish, right? And that would be your entry on both sides. This side for a call, this side for a put, and make sure that you obviously mitigate your risk. Make sure that if you're taking a call, make sure you try not to take a naked call. Try to protect your call. You could even do a spread if you like, right? You can do a couple of different things. You can do a bull spread if you like, or you could do a bear spread if you are feeling bearish, right? Once you get the confirmation, use a at the money option to fund the in the money call, right? At the money call option to fund a in the money call option, something like that. Lower your cost basis of the calls, right? You can do a bull spread. You can do multiple different ideas here, okay? And you can play a bounce. What you can also do is you can sell a put spread, right? You can sell a put spread. You sell it to somebody who thinks McDonald's is going to be bearish, right? For example, you sell two puts, okay? One that is at the money roughly, and then another that's out the money, right? And you sell this put spread to somebody who thinks that McDonald's is going to go down, but you think it's going to bounce. So what happens is this person is now paying you to hold the put, right? And you get a net credit, okay? So there are many ways you can go with this. Many different alternatives and solutions. Well, how are you guys doing today? I see lots of people in the chat here. Welcome to the webinar, guys. How do you find the information so far? I would definitely love some feedback to see how I can improve it over the next few times that I do this. This is the first one. I hope that it's not too jam-packed with too much information. Now, I'll let you guys type a little bit in the chat and let me know what you guys feel. But in the meantime, I want to definitely go through a little bit about candlesticks. Okay. Now, many people have, they study candlesticks and stuff, whatnot. Now, if you need a comprehensive video on candlesticks and you do not know where to go, you want some video or you want me to explain it to you, well, I have a video that does that. If you go to my channel, you go to playlists, click on active investments, and click on this video right here, beginner guide to candlesticks. You'll find a good explanation for candlesticks, and that video is going to pretty much show you or teach you how to use candlesticks for your your analysis. But a little bit about candlesticks that people don't know, right? You have to understand something. How do these support and resistance levels build up, right? Many people don't know this, and I cover this in the Everyday Growth Advisors mentorship course. I'm sure that you guys who use Robinhood or TD Ameritrade, you have access to level 2 data, right? Level 2 data on TD Ameritrade looks like... Okay, let me pull up a picture. Where is it? This one. Looks something like this. I'm sure that all of you guys know what this is, but you have never used it before and you never thought of using it before. This thing right here, right? This is your level 2 data. Okay, now what does this mean and how do you use it, right? But let alone before you even get into how do you use it and what it means, which is a lesson on its own, okay? What you should actually be learning right now in the basics is, what do you make of this stuff? The information that's on here, okay? Well, let me just tell you very simply what this relates to, okay? These are the lined up buyers and sellers for a specific ticker, right? Okay, and it's the same thing on Robinhood, okay? Same thing. I'm going to show you. This is how it looks on Robinhood, okay? Exactly the same thing. Let me use a different color here so it can be used on both of them. Let me see. Maybe red. No. I want to say orange. Okay, there we go. Now, on Robinhood, this is the same thing. The bid and the ask. The difference is Robinhood consolidates all the orders from all indices, all exchanges, and posts it in a book like so. Okay. So, first of all, what is the bid and what is the ask? The bid is going to be the lowest dollar somebody wants to pay for something. Okay, and this ask, okay, this is the highest price somebody wants to sell something. Okay, so this is the highest price somebody wants to sell. This is the lowest price somebody wants to buy. Okay, and the easiest way to remember this is you got to look at it from the perspective of the broker. Okay, from the broker. So look at it from the perspective of the broker, and you'll never get it wrong. This is something my econ professor taught me when I was studying finance in San Jose State University. So always look at it from the broker, and then you'll never get it wrong. So you say, okay, the bid is the price that people want to buy it at. And obviously people don't want to buy it at the highest, they want to buy it at the lowest. So the bid is always the lowest price people want to buy it. And the ask is going to be the people that want to sell it. And people who want to sell never want to sell at the lowest, they always want to sell at the highest. So the asks are all the people that want to sell. Okay. Now, what eventually happens is the order book is split into two. There are buyers that line up and sellers that line up, right? And what we call in between the bid and the ask is what we call a spread. Okay, and a spread represents the distance between the bid and the ask. In this case, the distance is 0.06, which is 6 cents. Now, when volatility goes up, what happens is that the spread goes down. Okay, the spread becomes 0.02 or 0.01 even. Why? Because there are more buyers for every seller. When volatility goes up, right? More people are buying and selling, right? So there are more buyers for every seller. Now, when the spread decides to become fatter and wider, like the spread goes to 50 cents, this means that volatility is very low, okay? And when volatility is low, that means that there are a lack of buyers and sellers, okay? There are a lack of buyers and sellers. These numbers are down, okay? So, now, when you see an order like this on the order book, what does that mean? And this in the order book, what does that mean? This means that there are 2.2 million shares that are being sold here. And these are 521K shares that want to be bought. There are people queuing up to buy these shares at these levels. Okay? But if you actually think about it, what does this represent? This actually represents your support and resistance. Okay? These levels that you see over here, okay, on your chart, they are actually those numbers. What happens is, let's say you have 2.2 million shares that are queued up over here, while buyers try to bid the price up, and then they fail, and then they come down, and then it tries to go up again. And then it fails, and then it comes down, and then it tries to go up again. And these shares, they dwindle. They become from 2 million to 1 million to 500K, and then eventually, boom, that wall is broken, and we go to zero, right? This is the reason why we say that you should wait for a break above a specific level. Like, for example, we were talking about McDonald's at 196, right? 196 was the level we were talking about. We want to wait for the break above this level because this is a key level of resistance. Okay? And we want to give ourselves an allowance of about $1 or $1.50 for market pressures to confirm that this is indeed a bullish movement. All right? So this is the reason why we wait and we see how and what occurs. This is literally a basics of candlesticks. Okay. Let's see here. Cool. Very helpful. I like the explanation of how you come up with daily watch list. Helpful. Also appreciate you walk through a potential trade idea. What would be a way to hedge a play like McDonald's without a spread? Bless you. Very helpful. Thanks, Corona. The good info, not Corona, Samuel. The good info is much appreciated. Now I know to be defensive with my cash. This is awesome. Okay, great. I'm glad that you guys are enjoying the stream. Okay. That's great feedback. I appreciate it. Keep it coming. Let me know what I can do better and help you guys more, okay? Okay, I'll get to the questions in a little bit. Let me complete what I was doing here. So, now, the candlesticks themselves, they are actually showing you the price momentum of the stock, right? Now, if you don't know much about candlestick mechanics, they are literally showing you the bulls versus bear story, right? The green candlesticks show you the price momentum pushing up, and whenever you have a candlestick with no wick, a missing wick, that's what we call this is a marubozu. Marubozu. These are extremely strong candlesticks that show a bullish power that will continue for a cycle or two. For example, this one. See that? Bullish marubozu, right? And then after that, what do you have after the bulls push the price up? You have bears to push the price down momentarily to try to fight and contest that level back. Okay. Now, very briefly, on TD or Ameritrade, this is exactly the same thing, except for with a slight difference. On TD or Ameritrade, they show you which exchanges those orders come from. Okay. These are all the list of exchanges. ARCA, NASDAQ, BATS, these are exchanges. Okay. PHLX, EDGX, VIRT, all exchanges and different bits from different exchanges, right? Excuse me. Now, these numbers over here are what we call the block size. Okay, and each one of these numbers represent 100 shares on TD Ameritrade. So this would be 500 shares, okay? Now, what happens if you are looking at your TD Ameritrade level 2 data and all of a sudden what you see is something like 100, right? On the bid side, well, this simply means that there is a big buyer that just came in that wants to purchase almost 10,000 shares at that price, okay? And the same thing can occur on this side, all right? So you have to be careful to look at those things when you're looking at level 2 data. That is what you're actually trying to figure out, okay? But what is more important is understanding that when something breaks over a support or a resistance, there's a reason why we say that we want to wait for a consolidation above support or a consolidation above resistance. This is the main reason, okay? Because of the market mechanics and the way that it works, supply and demand shows you the price action of candlesticks, okay? So whenever bulls are more powerful than bears, you will see that the price will start to run up. Why? Because demand is more than supply, right? And then when it starts to run down, what does this mean? It means that supply is now more than demand. So the candlesticks are helping you to track what happens to the supply and demand over time. Okay, and I'm going to give you guys a more in-depth analysis on how to build your watch list in a separate webinar, okay? Because what I just showed you just now was a very rough idea, but honestly, it's more than enough for you to even conjure your own watch list, right? But we will do that on a separate webinar. Perhaps on Thursday, when you come back for the charting webinar, we can do that one, okay? I can show you guys how to do your own watch list from start to end, okay? So that you don't have to worry about that, creating your own watch list or relying on somebody to make a watch list. You know, it's something that you can definitely do on your own, all right? Great. Okay, well, I think I'm going to answer some of your questions and then I'm going to end the stream. I want to keep these streams really short and succinct, okay? I hope that this stream was helpful. These are very quick webinars that you come in, you attend 30 minutes, you're out, and you're, going to learn a bunch of things. I want to keep them very, very succinct, okay? So I hope that you guys like it. Okay, let me answer a question here. What would be a way to hedge a play like McDonald's without a spread? Well, it depends on what play you're taking. If you're taking this to the upside, then if you have shares, then you can do a married put, right? You buy a put for the downside, right? If let's say you have 100 shares of McDonald's here, okay, and you're playing this to the upside, well, what you could do is buy a put, okay, and hedge it to the downside. And that put would cost you a certain dollar amount. Let's say it costs you $5. Well, now your cost basis, instead of costing you 100 shares at 194.33, right? Let's say the price is that, it's going to cost you plus $5, right? 199.33. So now your break-even price for McDonald's is now at $200, okay? And so, but then here's the beauty of it. The downside on your position now is very, very small, right? You can't lose money beyond where your position would be. The risk that you take on would offset. So if McDonald's were to make a drastic move down, well, this married put that you bought for it would pay as a insurance premium. Okay? That's one basic idea of how you can do that. Let's see here. Okay. Okay. Very helpful. Good info. Appreciate it. Thank you for all you do. More Mickey Mouse. Bless you. Thank you. Thank you, Shri. Appreciate it, man. Love these bite-sized sessions. Great, Tanya. I'm glad that you like it. When is the new beginner option class available? There is going to be a new wave in exactly, let me see. I'll tell you right now. Not this week. Well, not this week. Not the next week. So the next registration will be on the 15th. The 15th of August will be the next wave. Okay, and I'm going to start advertising it sometime this coming week. On the weekend or Monday, that's when I'm going to be starting to put out information about it. So make sure that you stay tuned for that. Millennia Chisco? Yeah. And you can take the course then with the next wave, which will be wave number 6, who's doing it. So, all right, I'm going to end the stream here. Hope you guys liked it. Leave a like, guys, if you liked it, please. That really helps me. You know, if you like the stream, just smash the like button, recommend it to your friends. Tell them about the stream and ask them to attend it. On Thursday, what we'll do is we'll go over charting. Okay, I'm going to show you guys like a crash course on charting, and so that should help you guys a little bit gaining directions. I'll give you access to my indicators as well. All of these, you can get them for free, and if you need it to be sent to you by email, I can do that as well. I don't believe in holding back any information. What's mine is yours. Okay, it doesn't mean that if I'm going to hold something back from you, I'm going to get smarter. So let the knowledge be free and easy. Knowledge is power. Let the power be with everybody. I don't believe in, hiding information from anybody. What I know is what you know. The only difference is that I spent some time gathering the knowledge, and now I want to pass it down to anybody who wants to learn. All right. So this is the main reason why the Everyday Growth Advisors was created. With that, I leave you guys to have a great Tuesday. Thank you for tuning into the stream. Have a wonderful day, and I'll see you guys on Thursday. Have a good one, guys. Peace out.